With inflation constantly raising prices, a lot of us are having trouble growing our money. The growth of income can no longer keep up with it, so it is a must that we look for another source to grow our wealth. And investing in stocks is one solution to this problem. One power that we can tap into investing is what we call compound interest. It is interest you earn on interest. As one of the greatest minds in the world, Einstein said, compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays for it. Investing in stocks already lets us use this in two ways: compounding capital gains and dividends. In capital gains, if we sell our stocks at a higher price than what we bought them for, then reinvest all the gains we get from it, and if the process repeats, sell at a higher price again, we compound our gains to earn more again and again. And in dividends, usually strong companies that earn consistently give out a portion of what they earn to their shareholders. So even when we don't buy and sell stocks constantly, we still earn money, and if we reinvest those dividends, we will earn more dividends the next time, thus compounding our money further. Once we repeat this cycle over and over again, for a long period, it will snowball to an amount capable of changing our lives. But the problem is, it may look easy, but a lot of investors fail to do this. They do the exact opposite and end up losing money. Rather than compounding returns, they compound loss after loss. Worse, some even use debt to leverage their investments, which worsens the situation even more. So for us to prosper investing in stocks, we need to know a few things before we start. And the first one is the most important: having the right temperament. One should know that stocks aren't a straight uphill. It has its ups and downs. As the great investor Peter Lynch said, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. With a good temperament, you would be able to control your emotions when stocks drop or when it rises so fast. A lot of investors fall into the trap of buying stocks high because of the fear of missing out. They think if they don't invest now, they would miss out on the great opportunity of this stock skyrocketing to the moon. But when they go in, the hype diminishes and a lot of investors have already taken profit, thus leaving you with a big loss because the stock price drops yet again. Instead of following the rule of buying low and selling high, they do the exact opposite. They buy high expecting it to go higher, then end up selling lower. Though you can be lucky sometimes if you're fast enough to take profit once a stock rises, but this wouldn't be a good long-term strategy. The same for when stocks are dropping. During market recessions or crashes, when a lot of great companies are in a discount, a lot are often afraid to invest because they think it's the end of the world. Stocks will never recover. Worse, some panic and sell all their stocks. And another cycle repeats itself when the market recovers again and stocks are hitting all-time highs. That's the only time some investors invest again, missing the great opportunity given to them during the recession. If you have a good temperament, you will be calm during these times and come up with a good strategy. You will remember the saying, to be fearful when others are greedy, and be greedy when others are fearful. You would not let your emotions decide for you, and you know that crashes are a great opportunity to earn more money. It is already a proven fact that you don't need to be smart to be successful investing in stocks. But with the right temperament and discipline, you would be able to achieve what the vast majority of investors fail to do. The next thing you have to know as an investor is to invest only in your circle of competence. This is an add-on to a good temperament, for knowing the companies you invest in helps as well in keeping you calm. Just think of it this way: would you panic when the company's stock price falls down if you know the company has good financials, managed debt, and has a strong competitive advantage? Well, it may be the exact opposite. I think you would even be happy that you get to buy that company at a discount. Most investors nowadays let greed and emotion decide what they will invest in. They only invest in hype companies, popular ones that influencers invest in. They no longer research and analyze a company if it is really a worthy investment or not. And when a recession or a market crash comes, they go into full panic mode because they know nothing about the companies they hold. A good investor will never invest in a company they lack knowledge of. You do not invest in every company they throw at you, but invest only in the companies you are comfortable holding for 10 to 20 years. By following this principle, your investing journey would be much more comfortable and you would be able to stay with it in the long run. And since you know how to filter stocks properly, this will further amplify the growth of your investments, for you will benefit in both capital gains and dividends. A thriving company has a greater potential to increase their dividends yearly, and when investors see this company as a good investment, this will increase the stock price. So before you hit the buy button next time, be sure to analyze and evaluate that company first. As said by Warren Buffett, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. And by the way, one platform that can help you research stocks is simply Wall Street. They have a ton of data available for you, from past performance, dividends, future growth, and other ratios that can help you analyze if the company is a worthy investment or not. They also have a portfolio tracker that can help you analyze the strength of your portfolio. So sign up now using my link below. They offer a forever free basic plan, and if you do avail their plan using my link, you can get 30 and even up to 40% discount. So what are you waiting for? Try Simply Wall Street. Going back, the next one is to be a long-term investor. Again and again, a lot of investors fall into the trap of short-term gratification and being impatient. As we discussed a while ago, compound interest. Now this magical power doesn't happen in a short time. It takes years to truly reap its benefits. Now I made a graph showing the growth of a monthly investment of 1,000 pesos in the Philippine Index from 1987 to 2022. If you lack the discipline to stay in the game during the downturn of the market in the early 2000s and sold your stocks too quickly, you would miss out on the great opportunity to multiply your money more than 3 times. Your total investment of 432,000 grew to 1.6 million. This also happens investing in individual stocks, as stated by the legendary investor Peter Lynch, who gained an annualized return of 29.2% in his years as a fund manager. My best stocks have been the 3rd year, the 4th year, the 5th year I've owned them. It's not the 3rd week, the 4th week. People want their money very rapidly. It doesn't happen. Now combine this with what I said earlier about knowing the companies you own. By having a long-term mindset along with it would put you on the right path to building wealth in the stock market. The last one to know is proper diversification. Now as they say, don't put all your eggs in one basket. But when you look for other baskets to put your eggs into, it has to be a good one as well. What's the point if the other baskets are filled with holes? Then you didn't actually minimize your risk, but rather added more to it. The same in stocks. You do not just invest in multiple companies for the sake of diversification alone. You have to do it properly. You still have to follow your circle of competence. Only invest in the companies you know and understand. This is the common mistake a lot of investors make. They blindly invest in a lot of companies, thinking they need to diversify. They forget the very principle of only investing in companies you think are a good investment. They fail to properly use diversification and end up making the situation worse. Remember, by investing in strong companies spread throughout different industries, then if one industry is affected, then your other stocks would compensate. This is especially true if you are a dividend investor. Let's take the pandemic as an example. Some industries that were the most affected, like real estate and power companies due to the work-at-home setup, cut their dividend payout. But if you're also invested in other industries that flourished during the pandemic, those companies gave you higher dividends, thus compensating for the companies that cut their dividends, and you may even end up growing your dividend income. So diversification, if done correctly, will have its benefits without you sacrificing gains. And other than diversifying over different industries, you also need to apply diversification across time, meaning you invest consistently over different time frames over a long period. Because let's face it, no one can predict the market. No one can predict when the stock market will rise or fall. So for you not to fall into the trap of timing the market and missing out on a lot of great opportunities, then you invest across different periods or by cost averaging. But you still have to follow the rule of knowing the companies you are invested in and of course, buying at a reasonable price. So in conclusion, the stock market is one way to grow your money and may eventually help you retire early, but you have to do it properly. Remember to always go back to the basics of having the proper temperament, investing only in the companies you know and understand, sticking to a long-term approach, and diversifying properly. Most successful investors have followed these rules and have achieved great results. This is what separates an investor and the speculator. So thank you guys for watching, and if you still haven't clicked the like button, then now is the time to do so. And if you still haven't tried Simply Wall Street, try it now. There's nothing to lose. It will help you out in your investing journey. So see you in the next video.